This is Mushima Gama, and I will be giving you some insights of ladies who invest. There became some importance because of a whole lot of stats, and statistics just places us out there that we are not the biggest investors. And what we're trying to do now is debunk that false notion. Though, as women, we have to admit that we are financially illiterate, and it's not by choice, but it is the fact that the information that's given is not relatable. Now, the first part of things, what are the fears that we women have about investing? Some women admit that their disposable income is less. Some of them don't see it as a financial priority. Some women feel the stock market is too risky. There's a lack of confidence in the investment knowledge, and they believe that it's a man's world. And then lastly is that they're not too motivated to invest. A lot of people say women are not as confident as investors because we tend to be more self-depreciating or have an imposter syndrome, no matter how educated we are. So the way the financial information is also communicated is a major deterrent in their confidence. Then they say women are risk averse. In fact, we're not risk averse, we're just risk aware. The people who are even advising us about the market are more traditional advisors that will tell us to stay in short-term bonds and cash equivalent to avoid risk. Then women are not interested in opportunities that align with their values, which is true. Women are not interested in investing, which is not true. So it's not that we're not interested in investing, it's just the communication style on how to invest is very poor. And then charts and graph feel dry and dull to most women in the way they are presented. So there is a huge reason why women are investing. It's because of the poor communication styles and the way they're presenting the information to us. It is totally not relatable. And that's the community that we would like to form. Fact is, women prefer to talk about money matters in a more relatable matter. They need to know how the investment is likely to affect their family and their lifestyle. But it should not stop you from being financially literate and finding out how to grow your money. What women actually do love, a sense of belonging in a community where we can all relate to each other. We like feeling good and safe, and we like sharing when we feel good and safe in a community. We want to be heard and seen in this male-dominated industry. We consider anything that benefits our family, and lastly, we appreciate connecting with like-minded people with the same ambitions and future plans. What we actually want is we want to break a generational cycle of financial illiteracy. We want financial information that suits our style of understanding. We want transparency, to feel involved and be active participants in our investments and not co-pilots of our investments. The reason why we want all of this is because investing is not only for the elite or very educated individuals, it's for everyone, no matter what salary bracket. We just have to make the effort. The good news is it's never too late to invest, and it's accessible to women of all ages because it does help better your financial stance. And your newly learned information can then be imparted or disseminated to your family, putting the end to this financial stagnancy that a lot of us women and a lot of families are in. You will generally, as I said, by taking a stand and saying, I want to know more about how to invest, you will be breaking the cycle of being in bad debt and financial illiteracy. You will then start building a legacy, and your family will then know the importance of continuing that legacy. However, you need to make your money work for you and not to be depleted. You need to know what is in your retirement annuity fund. You must ask, what sectors am I in and how they are performing against the market. You need to now take the reins to be financially illiterate and emancipate yourself. If you can pay for Netflix, a funeral policy fund, you can pay for your nails and makeup and all that stuff, you can certainly put money aside to invest. But as I said, the effort has to be made. Let's now get into simplifying the stock market. Stock market, to be honest with you, is one big public market. This is where shares are bought and sold over the counter. It's a market where buyers connect with sellers. So companies go to this market. So the market would be pictured as a JSE to present their product, which would be the shares, in a form of an initial public offering. It's called an IPO. The purchase or selling of these products with shares is done through different stalls and licensed broker. Then the stall owners will then differ in prices. Then this will be your brokerage fee. So you have to shop for brokerage fees because the brokerage fees themselves is quite important because they do take a part of your capital when you initially invest. What is the purpose of the stock market? It serves two very important purposes. It's to provide capital to companies to fund and expand their businesses. Now remember, when I spoke about the IPO, what that is if a company issues 1 million shares to sell for 10 Rand a share, then it provides that company with 10 million of capital to use in order to grow its business. So by conducting an OPI, the company avoids incurring debt and paying interest on that debt. You then would be asking yourself, why can't they just go to the bank and ask for money? Because it's a different type of interest. They don't have to pay interest to the bank if they do an IPO. Then the second purpose is to give investors, those who purchase the shares, the opportunity to share in the profits of the companies. So investors can then profit from buying the shares in one of two ways. So some stocks pay regular dividends. So you are not only going to profit from upward movement of the share price, that's the appreciation in the price, but you also can get dividends from profits made from the company because they've borrowed money from you now, which is a sum of money that's typically paid annually by companies to its shareholders out of the profits that have made. Then the second way would be, as I said, the appreciation of the share price. This means you selling your share price at a higher price than what you bought. Now, in other words, if you buy a share price of a company for 10 Rand a share and the price now rises to 15 Rand, it means you've realized a 50% profit from that. So it's from the profit, that's the 5 Rand you made, as well as the dividends. Now, is it safe to trade in the stock market? It is 100% safe because it's regulated by the law. The only thing that you need to shop on is if your broker is reputable. If it's a broker, if it's a reputable broker or a bank, it's all thumbs up. So how do you choose to buy these shares? I'll give you an example with just apples. If you get into a market and want to buy apples, it would be beneficial for you to then buy a freshly picked apple, right? If you can just picture it, a freshly picked apple, when you think of it as buying shares, it is before upside begins. They then become something similar to freshly picked apples. So you are going to try and pick freshly picked apples, which are ones that the shares have now recently broken out of their trends, because you don't want to get into the market and pick an overly ripe apple, because an overly ripe apple is a share that has already gone up so high that it's time for it to start pulling back. Now, for example, once you have bought a freshly picked apple, of course, this would be the progression of the upside. It will continue going up, 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 up until it reaches a very high level where it's now time to get out. So this is where you initially want to buy. But you can also buy whilst the upside is still intact. You can also buy, at this point in time. But at this point, when it's starting to look overly ripe like that, it's time to start selling. And this is when you start selling gradually. And by the time it's very ripe, that's when you've completely sold. And this is when the share price is at its highest price. Now, there are different sectors of the shares. Giving an example with the apples again. As you may see, there are different kinds of apples. And when I say there are different types of apples, I would refer to something like the metal sector. So you would have your metal sector and the different names. For instance, your Anglo Gold, Impala Platinum, Northam, your GFIs, which would be your Goldfields. So they're all different types of apples within a metal sector. It could be another sector, it could be a retail sector. That is probably different types of bananas. So in other words, they all do the same functionality, potentially even taste the same, but they're just different types of companies within the sectors. The shares of a sector tend to kind of trade the same. So if retail sector is bullish, meaning that the share prices are going up, most of the shares in that sector will probably follow suit. So some people invest in a sector or some people invest in an individual. Okay, so now let's look at the instruments that are available in the stock market. So a financial instrument is a real or viral document representing a legal agreement that involves any kind of monetary value. So in other words, it is a document that can be used, for instance, a share certificate. And the type of financial instruments that are available can either be equity-based, they can be debt-based, or they can be foreign exchange-based. And when we say equity-based, it represents ownership of an asset. So you own the asset. Debt-based are loans made by the investor to the issuer in return for an interest. Or it could be foreign exchange. And in this case, it's a market where currencies are exchanged. When we talk about stocks or equities, they mean it's an ownership of the shares issued by a publicly traded company. So as I said, you would own a certain percentage of the company. How do you make money with stocks or shares? So generally, it's either through the rise in the share price or by receiving dividends. So the risk involved in that, depending on the type of share that you're in terms of its volatility, as well as the volumes that are being traded, the risk involved can range from high, medium to low. When it comes to bonds or fixed income, how it works is that bonds are issued by governments and corporations when they want to raise money. How do you make money from these bonds? The face value of the loan on a specific date. So you can also then get periodic interest payments along the way, which is usually twice a year. The risk there is low. It's not like equity, so there's very low risk there. Then there is cash or money market funds. Now, they're designed to offer a safe and stable investment option for money you may need to access in the short term, like an emergency fund or a short-term goal. So the money market fund, what it happens is it pools money from many investors to invest in the money markets. So unit trusts act as something like from the money market funds. It's a type of investment that combines your money with the money of other investors who have similar investment objectives. You can invest anything from up to 3 to 7 years, depending on what your needs are. So this would be seen as a low risk. So how do you make your money? By investing in well-performing assets. So it's usually in companies of shares, bonds, property funds, or another way of making money is the fund will pay you out as well. So it does act like a bond a little, some annual returns, either income or growth, and you can decide if you want to receive the money or reinvest it back into the money markets. So the risk here is quite medium. All right. Then it's the index funds. This is where the ETFs, which are different in a sense that when you invest in an ETF, you get a bundle of assets you can buy and sell during market hours. ETFs offer investors diversification. So you're not only investing in one sector, like how you would do with the money market, but you could have a whole lot of shares in one little basket. So single shares offer potential of higher returns, but carry higher risk and require more research and monitoring. Okay, you can buy an ETF or track a sector in an index, stocks of a specific country, commodity and currency of a fixed income. So this ETF would track what the index is doing. And since if the index is going up, your ETF is probably going to go up and so onwards. So how do you make money from there? You're selling at a higher price than what you bought it for. for. So it's the same as equity, but in this case, it's a basket of shares. And investors can also receive dividends. Why should you consider investing in the stock market? Because it is a good side hustle. Honestly, the type of information that we disseminate, you wouldn't have learned at university, so you don't have it at your disposal. And once you do have it, it's information that cannot be taken away from you. You will then know, even when you're retired, if you know how to invest in the stock market and you know all the things, you know how to trade, it becomes a nice thing that you do on the side. Investments and businesses are similar in the sense that you both need to commit some money in anticipation for future profits or benefit. So if you're investing in a business or investing in shares, it's a similar act, but there are different types of risks to that. Starting your own portfolio of shares is literally like starting your own business. Now, if you had a lump sum of money, do you want to start a business or do you want to start a portfolio? The involvement of starting operational business is that there's daily management needed and interacting with customers and shareholders. I mean, shareholders in terms of the people who have invested in your business. Then your investment portfolio means you play a more passive role. You're just buying and holding shares. And the overhead costs for an operational business is rent, electricity, water, levies, etc. Of starting a portfolio, it's just brokerage fees. The operational business is capital intensive because you're either using your personal money or you're incurring a debt. So you go to a bank to offer you money in order to run your business. With an investment portfolio, less money is required and it can just actually be your monthly savings. Then operational business involves employees. It means you have to pay salaries. An investment portfolio, your employees are just shares and there is no emotional attachment to that. Operational businesses, the risk is high, and with investment portfolio, you can always diversify your risk. So that is the difference between when I say it can be a nice side hustle, it doesn't necessarily have to be an operational business. Starting a portfolio could be seen as a side hustle. The benefits of investing, it gives you more financial independence because savings held in cash will tend to lose value. So in other words, if you're going to put your money in a savings account, it will tend to lose value because of inflation. Specifically with inflation being, okay, well, we've got it now back in the desired 3 to 6 rand band. But when inflation is high, that does gnaw into the value of your savings. Investing can help you protect the value of the money as the cost of living rises. It helps you take control of your own family's finances and financial independence, as I said. Potential capital gains from owning a stock that grows over value of time. That is the benefit of starting your own portfolio. And remember, you're also getting dividends that are paid and also lower taxes on long-term capital gains. You don't get taxed as much. A few enticing examples of why you should be investing in the stock market. For example, this is an Affirmat share. You would be getting, this is where your ripe apple would be. Because I use technical analysis, it has a lot of levels. So this is where your ripe apple would have been. And that's where you would have made a nice 52% before the ripeness of the apple and before it pulled back. But as you can see, the market does not go up in one linear direction. There are these pullbacks that might make you feel that should I be getting out? But for as long as the uptrend is still intact, it means you still remain in the share. So you would have made a nice 52% on that profit. Now, this is what I mean when I say broken out of a bear trend. For example, Aspen. It had been in a bear trend and it then broke out of that bear trend. So this is where your freshly picked apple would be, and that's where the ripe apple would be. This is where your freshly picked apple would be. And if there was continuous upside, but in other words, this would be where the ripe apple is being. That's the freshly picked ripe apple concept I'm trying to make you understand. So in this case, if you had bought it freshly picked at that price because it's now getting out of its bear trend, it traded up to 252. That was a nice 36%. And if it would continue with this upside and it maintained this uptrend, it would have gone to where that price is, which is what share prices usually do. If they fall drastically, they have a tendency to gradually go up to the starting point of the fall. Now, if you left that as a long-term investment, it then means you'd be getting a 42% gain. Another one that's a bear trend, and now it's breaking out, which would be then you picking the fresh apple at this point. So in this case, you'd be picking the fresh apple at 16.40 with potential upside to 26.35, which is a nice 38%. And if it continues with its uptrend, it could even go up to 31.50, which then increases your gains to 48%. Can you see how the whole concept of are you getting it when it's freshly picked or when it's ripe? You don't want to get it when it's here. And that's what usually happens when you see prices going up. Now people are now starting to get in thinking that the price is going to go up quite drastically, but that's when it's completely ripe. And that's when you should be getting out. What does share tracking offer? It offers you 24-hour support. It offers you one-on-one training sessions in order to understand this, webinars and other educative material. And there is data and a simulation. In other words, you can practice how you do on a demo before you start putting real money. Supportive and inclusive community, which involves all of us. You can ask any question by calling support. Everyone is there to assist you. It's imperative that you need to gain information about what stocks to track and watch from experts so you can learn how to trade independently, which is where share tracking then comes in. That's it. I hope it was encouraging. This is just a tidbit of what the community would probably be looking to doing in terms of relatable way of disseminating the information.